Hey YouTube, I'm Jimmy. In this video, we're going to go through how to find great dividend stocks. We're going to look quickly at the dividend screening process that I use. It includes some financial statement ratios that I think are helpful in identifying companies that have the ability to cover their dividend, maybe increase it, and ideally keep growing their business, which will ultimately help our dividend stocks raise in price. So our goal here is to find the best dividend stocks, the most stable ones, not necessarily the highest paying dividend stocks. We want stable dividend providers that can continue to increase their dividend. Okay, so there are many different screening tools available to us online. And for this video, I'm going to use the CNBC stock screening tool. I'll throw a link in the description below if you're interested in using it. It's free, so that's good. Now, I think that there are many different screening tools, and the one that we choose is almost unimportant. To me, the most important part is the criteria that we're using. As long as the screening tool that each of us are using can use dynamic enough criteria, I'm happy with it. Okay, so let's imagine that we're going to try to identify 2 or 3 different companies that are likely to be great dividend paying stocks for the next few years. So we're going to try to narrow down the list, and then once we finish that, I'm going to show you different things that we could do, that I do, to adjust either to make the list longer or shorter, depending on what the results are. Okay, so the first one I like to include is return on equity. Return on equity, or ROE for short, is in CNBC's management efficiency category. Now, in theory, we want return on equity to be as high as possible. But to keep our list under control, I'm going to enter in a return on equity of greater than 17%. Why 17%? Well, I checked, and the average return on equity for the S&P 500 was about 17%. So we're going to say we want ours to be better than that. Now, another option would be to just go with the highest in the industry. That would probably give us some interesting results as well. But for now, 17%. Now, the next criteria is crucial for what we're doing. If we're going to use return on equity as one of our criteria, then I believe we should almost always use a measure of debt to pair with it. In this case, I'm going to use debt to equity. CNBC keeps this under the financial strength category. Now, we want debt to equity to be low. Less debt is better. So here, I'm going to use the lowest in the industry. They default this to 20%, and that seems reasonable to me. I'm sure we're going to come up with interesting results. Now, it's important to add a debt measure because we can't forget that return on equity is calculated by taking profits and dividing by shareholder equity. And this is a formula for the balance sheet. And if we were to rearrange this formula, well, we can see that assets minus liabilities equals owner's equity. So knowing that the return on equity formula is net income divided by owner's equity, well, management has 2 choices to improve return on equity: grow net income or lower owner's equity. You can lower owner's equity by simply taking out more liabilities. More liabilities, smaller owner's equity. Smaller owner's equity, given the same level of net income, higher return on equity. Now, this could be interesting if you ever see a management team pay structure, or maybe they get stock options or some sort of bonus incentives based on perhaps return on equity being higher. If that were the case, well, management could simply take out more debt and drive return on equity higher without actually improving the fundamentals of the business. So we put these 2 ratios together, and we'll make sure that nothing crazy is happening. Okay, back to identifying great dividend stocks. Now we can add the dividend yield that we're after. For that, we're going to go with greater than 3%. Then we're going to go add the dividend payout ratio. Both of these options, by the way, on the CNBC screening tool, they're in the dividend section. Well, for the dividend payout ratio, this is very similar to the dividend coverage ratio. The dividend coverage ratio looks at how much profit a company has compared to how much dividends they pay out. The payout ratio is just the opposite of this. It's dividends divided by profits. So for us, the lower the dividend payout ratio, the better. I'm going to go with a dividend payout ratio of less than 60%. This means that for every $100 in profit the company generates, well, they could pay out $60 in dividends. Okay, then we're going to add the 5-year dividend growth rate. I'm going to use a 5-year dividend growth rate of more than 8%. Why? Well, once again, I looked at the S&P 500. That's about what they grew over the past 5 years. So I figure, why not? That seems to work. Okay, now this leaves us with 15 different companies. Now, one of the things I like about this type of screen is that this tends to pull down companies that are somewhat unique. And I'm a firm believer that generally what we want to do is we want to identify companies that are a bit away from the norm. That's, I think, we could find the most value and the most opportunity. Why would we want to be in the same companies as everybody else? How much room do they have left to run if everybody else already bought them? How are we going to outperform? Now, the next step is actually more time consuming than I can cover in just one video. And that is working through this list of 15 companies and narrowing it down to the 2 or 3 companies that we like the best. But there is a trick that I saw Charlie Munger talk about, and that is, he called it invert. Always invert. So the theory there is that when we're analyzing a list of companies like this, what we should do is we should look at each one and say, what could go wrong with this company? Then what we do is we start crossing companies off the list based on what we think is most likely to go wrong. Keep crossing off the bad ones. In theory, you're left with the good ones. Okay, my first thought on this list is ESCA. That's a $172 million company. They're paying out a dividend. What for? Personally, I think that a company that small should keep the money and try to grow the business. I'm not investing in a small company for the dividend. So I'm going to cross them out. L&D is right in line with that same thing. They're only a $238 million company, so we'll cross them out too. Just like that, our list of 15 goes down to 13. Broadcom is a popular dividend-paying stock. I've looked at them before. Gap is up there. I'm curious how that's up there. I know that brick and mortar retail has been struggling. I wonder what their profit margins look like, what the revenue trends look like. We could quickly look at the profit margins for each of these companies and probably cross a few more off. Another way to continue the inversion process is to look at sectors. Perhaps our portfolio already has plenty of exposure to the financial companies. So, we could eliminate these 3 if we don't want any financial companies. Well, maybe it's retail that we're fully exposed to, and if we were to cross retail stocks out, those 3 companies are gone. The point is, I think it's easier and certainly faster to do research if we're looking for why we shouldn't invest in a company. And then in theory, what we'll end up with is a handful of possibly the best dividend-paying stocks. Now, if we jump back to the dividend screening tool for a second, here, I think that it's important to realize that we could play around with this. Some of these numbers, if we didn't want a 3% dividend yield, if we wanted 2.5%, we'd get more companies. Raise it up to 3.5%, you're likely to lose some companies. So we feel free to play with these in different areas to either make your list longer or shorter, depending on how comfortable you are with the inversion process and researching companies in general. Either way, with this screen, I like it because what we end up with is we seem to end up with companies that are fairly efficient. We know that because of the ROE criteria. Our debt rules should imply that we're eliminating at least some of the garbage companies. We've got a decent dividend yield. I like the 3% number. And we believe that they can cover the dividend and have the possibility of continuing to grow it in the next few years. With just a bit more research, it's possible that we could find some real gems in this list or a similar list if we were to adjust the screening process ever so slightly. That being said, are there any criteria that I left off the list that you would have included? Let me know what you think in the comments below. The other thing is that are there any companies on this list that you think are interesting? Because perhaps we could do a video analyzing some of these stocks and we could look at how good the dividend screening process how good are the companies is it's actually producing for us. If that's the case, any ideas on any companies, post them in the comments below. Whatever gets the most posts, I guess we could do a video on that. Let me know what you think in the comments below. Hit the subscribe button. Thank you for sticking with me all the way to the end of the video, and I'll see you in the next video. Thanks.